Welcome back. You're still watching Street Signs on CNBC TV 18. Before the break, we were in conversation with Sanjay Dutt of Quantum Securities. Now let's invite our next guest, Nilesh Shah, MD and CEO of Envision Capital, who joins us. Hi Nilesh, good to see you in after a while. It's been a fabulous run for our markets, but at 28,000 on the Sensex, what is the recommendation to investors?
Well, clearly the markets have exhibited a fair bit of momentum, and you've clearly seen the markets scaling new highs. Obviously, of course, the source of the up move has clearly been the liquidity flows which have been coming into the markets, both from international investors as well as domestic investors, and that's clearly been fueling this rally. But on the other hand, clearly the earnings support has not yet come in. And so clearly the markets are very interestingly poised, and one clearly has to see going forward what happens first, which is, does the liquidity dry up first, or really the earnings take off and create another wave of an up move in this marketplace. So clearly I think over the next 1 to 2 quarters, it's going to be really a tug of war between liquidity and earnings growth. And I think at this stage, given that it's going to still take a few more quarters for the earnings growth to come in and for margins to improve, I think one has to be a little bit of cautious at this kind of stage. You could still be positive about the outlook from a 1 to 2 year perspective, but clearly from a 1 to 2 quarter perspective, one has to be careful and cautious given where the markets are.
Hi Nilesh, what do you think would be the more likely outcome? Do you see the market giving up some of its recent gains, or in a market which is fed by such strong liquidity, it may just do some kind of time-wise consolidation before the next trigger comes up?
Pretty much the second case, which is that you could see these markets do a time-wise kind of consolidation. Clearly, if we really look at the last several years, as we head into the calendar year end, clearly there is again on one school of thought which believes that there's going to be profit booking around the corner, but as we step into the new calendar year, the allocations for the new calendar year as well as expectations out of the budget clearly provide the tailwinds to this market. So you could clearly see this market which moves up maybe another 3 to 5% and then pulls back by about 2 to 3%. I probably think that you would see a range-bound market between now and the budget, where the Nifty could still try to kind of go higher, but at different points of time could get scaled back because of the threat or the vulnerability of a risk-off trade in the global markets. So it's going to be a very interesting period where on one hand you could clearly see hopes of new allocations coming in and hopes of reforms coming in before the budget or at the time of the budget. On the other hand, the global concerns could come in, they could get even magnified and play themselves out well. So I still believe that you would see on the whole over the next 3 to 6 months a more time-wise consolidation playing out rather than some very deep cuts in the marketplace.
Do you see interest rate cuts in India becoming or emerging as a trigger or some kind of tailwind for the market anytime in the next 3 months? Because for the last many quarters we've only spoken about it, but it has never been a real trigger. Do you see that changing in the next 3 months?
Within very unlikely that there are going to be rate cuts in the next 3 months. Obviously, of course, given with the way inflation is headed, there is a case for a rate cut, but I'm not too sure about the timing. I think a more possible or a more likely situation is going to be over the next maybe 6 months or so, or maybe the start of the next financial year. So I'd probably think that rather than between now and the budget, I probably think that it could be more somewhere around the Q1 of the next financial year. And that's not so much data driven, but if you really look at what the central bank has been saying, is that they want to basically ensure that the inflation trajectory is decisively down. I don't think they're looking out for some temporary softening in the inflation trend, but more of where there is a structural decline in inflation rates and where the Jan 2016 target of 6% is very visible and very strongly visible. So I'd probably believe that I'd put a very low probability of rate cuts in the next 3 months, but I'd put a higher probability of rate cut maybe over the next 2 quarters or so. And I think when that happens, that's going to be a huge positive, because when that cycle starts, the rate cut cycle starts, it's not going to be a rate cut of 25 or 50 basis points. I think it's going to be a very aggressive rate cut cycle. And therefore I believe that it might get delayed a bit, but when it happens, it's going to be far more decisive and a lot higher than what the street expects. And that is going to be a very important trigger or a catalyst for not just the markets, but I think even for corporate earnings. And that is going to be an important driver for kickstarting the investment cycle. So our sense is that if we really take a slightly more longer term horizon, maybe a horizon of say over the next 12 months, I think two things look reasonably certain. One is the start of a rate cut cycle, and two is the start of better growth rates in terms of GDP.
Slightly medium-term question, what should the asset allocation strategy be for the next, say, 8 to 12 months? We've seen a big fall in gold already. Is it that kind of a bull run where you move your money out of gold and into, assets like equities?
Absolutely, Sonia. I mean, I think leaving aside what could happen over the next few weeks or next few months, because gold has declined and equities have rallied, so you could see actually, pullbacks in both the asset classes. But clearly over the next 12 to 18 months, I think gold is something which has to be completely avoided. I don't think any incremental allocation should be made to gold. If at all, if there is any bit of rally in gold prices, I think that should be used as an opportunity to completely exit out of gold and of any of the other hard assets. And it's time to completely move into financial assets. So the discussion should honestly not be between hard assets and financial assets. The discussion should be that where in financial assets should an investor be in. And clearly I think the options are just two. I mean, on one hand you have equities and on the other hand you have fixed income. Fixed income looks even pretty much interesting, because if interest rates are headed down, then long-term bond portfolio should do well over a 12 to 18 month cycle. And of course I think clearly in equities there seems to be a situation of a secular up move where you could be in for some double-digit returns over a 2 to 3 year time frame. So clearly I think rallies or pullbacks in gold should be used to completely exit, and I think that allocation should be moved into financial assets, that is equities and fixed income.
All right, Nilesh, on that optimistic note, we'll let you go. Thanks as always for joining us and giving us your view. So then the sense you get from both the experts is that even if there is a correction, it could be a very shallow one. And I think the more lucrative strategy would be to go out there and look for good quality names to buy.
For now, Sonia, that should be the script, that you wait for those dips. When you get them, you be brave and pick up good quality stocks and hope that the market bounces back. Maybe the script changes at some point in time, but as they say, if it ain't broke, don't try and fix it. For now, the trend remains very, very strong in the market, fed by great momentum. That momentum might falter a bit over the next few weeks. That's certainly possible because we've had a great run. But for investors, those should be opportunities. At any point in the market, you can't be complacent. Maybe things will change. Things can change, and we'll take stock of that. But for now, I think buying the dips remains the strategy for investors who have missed out. I don't think there is too much debate on that score.
Okay, we'll end the show on that happy note. Thanks so much for watching Street Science.